Imagine you've got that electrifying idea, the one that truly keeps you up at night, sketching out possibilities, seeing how it could, well, change things. It's an incredible feeling, isn't it?
It really is. That initial spark.
But then, pretty quickly, the big question hits. Okay, how am I actually going to fund this? How do I bring this vision to life? And that's often where the dream meets the very real challenge of finding capital.
The money question always comes up.
Welcome to the deep dive, everyone. We're continuing our series, Navigating a Business Model.
Yeah, in this series, we're really breaking down the core parts of a business model, taking these big strategic ideas and turning them into, actionable little pieces.
Atomic units, we call them. The aim is always clear explanations, practical insights, whether you're just starting out or you're leading an established company.
Making it usable.
Exactly. And today, in episode 20, we're diving deep into funding your vision. What investors look for.
Okay, this is a big one for a lot of people.
It is. Our mission here is to give you a clear, sort of insider's view into how investors actually think. We're talking angel investors, venture capitalists, the whole range.
So you can shape your pitch effectively.
Precisely.
Yeah.
We'll talk about what makes a business venture-backable. And hint,
Yeah.
it's definitely more than just having a good idea.
Oh, yeah. Much more.
And we'll cover how to structure your pitch, how to present a credible business plan, a solid financial plan.
And we really want to emphasize thinking from their side of the table, understanding the kind of growth they need to see, speaking their language, essentially.
Right. So let's pull back that curtain, the investor's mind. What actually makes them lean in and say yes?
Well, like you said, it's not just about having a brilliant idea. That's, I think, where a lot of entrepreneurs get tripped up. You know, you pour your heart into this amazing plan, and then a VC turns it down. It doesn't necessarily mean the idea is bad. It often just doesn't fit their very, very specific criteria.
That's fascinating. I mean, we hear VCs are selective, but what's really driving that? Is it just risk aversion or?
It's more about their own business model, actually. Think about it. VCs spend a lot of money just investigating deals, doing due diligence, negotiating terms, then monitoring the companies they do invest in.
Right. That all takes time and resources.
A ton. So they can only back a tiny fraction of the ventures they see. And here's the kicker. There was a study by Venture Economics, Inc., looking at VC portfolios.
Okay.
It found that about 7%, just 7% of their investments generated over 60% of their total profits.
Wow, 7% drives 60%. That's incredibly concentrated.
It is. And get this, a full third of their investments end up as a partial or even a total loss.
Oof. Okay.
So this forces them into what people call the home run mentality. Because so many bets don't pay off big or fail completely, every single investment they do make has to have the potential to be a massive win, a grand slam.
They're not looking for steady singles then. They need those huge outliers.
Yeah, exactly. They need those outliers to make the whole fund work. So your pitch isn't just about your success, it's about how your success becomes their home run, making their portfolio math work. You've got to frame it that way.
That really shifts the perspective, doesn't it?
Hmm.
And you mentioned something else, that investors prefer predictability, even though entrepreneurs often embrace change.
Yeah, it's a bit of a paradox. Entrepreneurs thrive on adapting, pivoting, dealing with uncertainty. But investors, they generally prefer plausible, well-thought-out plans for markets they can understand.
Why is that?
Well, a solid plan gives them confidence in the entrepreneur's competence. It also gives everyone an objective way to measure progress, to test the assumptions you started with. It provides some structure in a chaotic environment. They want to see your path to creating that predictability.
Okay, so the home run thinking, the need for a clear plan, that leads directly to their other huge expectation, right? Growth. And not just any growth.
That's right. Significant growth, like growing, like wildfire kind of growth. But it's more than just getting bigger. It's about exponential, potentially disruptive growth.
Disruptive.
Yeah, think about consumer adoption. For people to really change their behavior and adopt something new, the product often needs to be 10 times better than what they're currently using. That's the 10x effect.
Right, a huge leap in value.
Investors kind of look for that same 10x leap in their return on capital. Your pitch needs to show how you deliver that kind of outsized value, not just for customers, but for them. Think of Zara, how they just exploded by rethinking fashion supply chains. That's the kind of velocity investors get excited about.
10 times better, 10 times return.
Yeah.
That's a high bar. Okay, so if you understand that drive, the home run, the exponential growth, then the next step is figuring out the actual funding landscape. Who do you talk to and when?
Yes. The timing is crucial, and almost always, the very first money in is yours, your own skin in the game.
Right, the entrepreneur's equity.
Absolutely. It's not just cash, it shows deep commitment. Investors feel much better if you've got a significant chunk of your own assets tied up in this.
I've heard some people say it's almost better to put in, say, $50,000 of your own than $1 million if you plan to raise outside money.
Yeah, there's an argument for that. It really underlines that you're all in, that you believe in it enough to risk your own capital. It shows grit.
But what if you genuinely don't have $50K lying around? Is that a deal breaker?
Not necessarily a deal breaker, but you do need to demonstrate that commitment somehow. Maybe it's sweat equity, maybe you've won some grants, maybe you've bootstrapped like crazy to get early validation. The point is showing you're personally invested and won't just bail when things get tough.
Okay, so demonstrate commitment one way or another. Then, once your own funds are tapped out, where do you usually go next?
That's often when you approach angels. Private investors could be family friends or, more formally, wealthy individuals investing their own money.
And successful entrepreneurs often become angels, right? Paying it forward.
Very often. They understand the journey. And there was an interesting trend starting in the late 90s where individual angels started banding together.
Like angel groups.
Exactly. They
Right.
pool resources, share the work of checking out deals, due diligence, share contacts, and structure more sophisticated deals. Sometimes they even take a board seat, getting more involved. It provides more than just cash. It's expertise, too.
Okay, so personal funds, then maybe angels,
Yeah.
and then come the VCs. Typically later on.
Generally, yes. VCs often come in when some of the initial risk has been reduced.
Okay.
They want to see that you've hit key milestones.
Like what kind of milestones?
Things like actual customer sales, revenue coming in, proof that your business model actually works, maybe even profitability, or at least a very clear path to getting there.
So you de-risk the venture somewhat.
Precisely. And because the risk is lower, you can usually get growth capital on better terms, meaning you give up less equity. And VCs are often ready to write much bigger checks at this stage.
Makes sense. But VC money often comes with strings attached.
Right.
They structure deals carefully.
Oh, absolutely. They often want what's called a preferred return or priority return. Basically, they get their money back first or a larger share of early returns. And they almost always want some measure of control.
How do they get control?
It could be through loan covenants if there's debt involved, specific terms in the investment agreement, or very commonly by taking seats on your board of directors.
Can you give an example of how that preferred return works?
Sure. Let's say a VC invests $4 million for a 40% stake. They'll usually get convertible preferred stock. This implies the company is worth $10 million after their investment. That's the post-money valuation.
Okay.
Now, if the company sells later for, say, $100 million, the VC converts their preferred stock to common stock and gets their 40%, which is $40 million. Like a great outcome for everyone. But if the company sells for a much lower amount, say only $5 million, the preferred stock terms might allow the VC to just take their $4 million back first, like debt repayment. In that scenario, they might get most or all of the $5 million, leaving very little, maybe nothing, for the founders, even though they own 60% on paper initially.
Wow. That's sobering. It really highlights their downside protection.
It does. They structure deals to protect their capital if things don't go as planned.
Okay, so we have personal equity, angels, VCs. But the landscape's evolved, right?
Yeah.
What about things like accelerators?
Yeah, accelerators are a big part of the early stage scene now. Think of them like incubators, but they usually add direct access to funding and very structured coaching or mentorship.
And you give up some equity for that.
Typically, yes, maybe somewhere in the range of 6% to 10%. But getting into a top accelerator like, say, Y Combinator or Techstars is like getting a stamp of approval. It acts as a signal to other investors and can really help attract later funding rounds. It's a valuable badge.
And another player we hear more about is corporate partners, acting as strategic investors.
Right. They usually come in later once the technology looks viable or the business model is proven. They're often willing to invest at a higher valuation than purely financial investors like VCs.
Why is that?
Because they're looking for more than just a financial return. They want strategic benefits, access to new tech, entry into new markets, maybe talent acquisition, things that help their core business. It's a different motivation.
Okay, so that maps out the main players. Now let's switch gears to crafting the pitch itself. How do you actually talk to these investors in a way that resonates? Rule number one seems to be know your audience.
Absolutely critical. Do your homework. First, be crystal clear on your objective for the pitch. Are you looking for money? A partnership? advice.
Makes sense.
Then really dig into who you're pitching to, what matters to them. Get objective data to back up everything you claim. If you're talking to sophisticated VCs, you need to focus on cash flow, profitability potential, market size, not just the cool features of your product.
And using insiders or networks can help here.
Immensely. If you can find someone who knows the investors, they might tell you who's actually going to be in the room, what their hot buttons are, why they agreed to hear your pitch, any potential concerns they might already have. That kind of intel is gold.
Okay, know the audience. Then the business plan itself needs to be more than just numbers, right? It needs to tell a story.
Exactly. A good business plan tells a coherent story about how you're going to succeed. It needs to be laser focused on the customer. Who are they? What's the market need? How big is the market? Who are the competitors?
And based on solid assumptions.
Yes, credible assumptions. And you need to be upfront about which assumptions are most critical to your success. If X doesn't happen, what's plan B?
You also need to clearly state your competitive advantage, right? What makes you different and how you'll stay different.
Absolutely. And crucially, you must address the risks. Don't hide them. Identify potential downsides and explain what you're doing to mitigate them. Investors respect realism about risks. It shows you've thought things through.
It's all about managing that risk-reward balance.
Tilting it towards reward, always. Another huge factor. The people.
The team.
The team. Smart investors often say they bet on the jockey, not just the horse. An experienced, known team can make a huge difference. Suppliers, customers, future employees, they might be more willing to engage with people who have a track record, even if the company itself is new.
So you really need to highlight the team's experience and background.
Definitely. Don't bury it. It's not just about the idea, it's about who can actually execute it.
And then the financials.
Yeah.
This has to be rock solid. You mentioned the profit formula.
Yes, this is fundamental. You need to know your contribution margin, how much profit you make on each unit sold before fixed costs. You need to know your fixed costs. And combining those tells you your break-in point, how much you need to sell just to cover costs.
Investors need to see you understand the basic economics of your business.
And how those economics change as you scale up. How will your margins improve? Will fixed costs increase? What's the investment needed relative to revenue? And a really critical one, what does your cash flow curve look like?
The cash flow curve, meaning
Meaning, how much cash will you burn through before you start making money? How deep is that trough, that period of negative cash flow? And when do you expect to climb out of it and become cash flow positive? They need to see that you understand the cash required to get there.
okay. And when you're presenting the actual solution, the product or service,
Try to minimize the perceived technology risk if you can. Show that you're integrating proven components or technologies rather than relying entirely on something completely untested.
demonstrate feasibility.
Exactly.
Yeah.
And highlight key partnerships if you have them. Maybe a deal that secures essential supplies or helps you navigate regulations faster. Show that you're building an ecosystem, not just a product.
And constantly compare yourself to the competition, showing your advantages.
Yes. Be specific. Do you have more revenue streams, lower costs, better efficiency? Maybe you have 6 ways to make money while your competitors rely on just one. Spell out why you win.
It sounds like a lot to cover. Which brings us to the last point. Practice.
Ow, huge! Pitching is a performance. You need to practice relentlessly. A good rule is one full, timed run-through for every minute your presentation is supposed to last.
Really? That much?
Yes. Start practicing alone, and then with trusted friends or advisors, then maybe existing investors if you have them. Get comfortable being uncomfortable.
Huh?
You need to be able to handle tough questions without getting flustered.
Internalize the story. Anticipate the question.
And project confidence, it makes a massive difference.
Okay, so let's quickly recap this deep dive. We've talked about getting inside the investor's head, especially VCs, understanding that home run mentality, their need for massive growth, and their preference for well-laid plans.
Right. And we walk through the funding pathway, starting with your own equity, moving to angels, then potentially VCs, and also considering accelerators and strategic corporate partners along the way.
And we hit the key elements of a winning pitch. Really knowing your audience, telling a compelling story in your business plan, highlighting your team, nailing the financials, presenting a de-risked solution, and practicing until it's second nature.
It's about showing them you understand their needs as much as your own vision.
So as you go out there to fund your vision, remember this. It's not just about proving your idea is good. It's about convincingly showing them how your venture represents their potential for a game-changing return, while also proving you've got a firm handle on the risks involved.
Which leads us to our provocative thought for you. How will you frame your pitch to show investors not just the dream you're building, but the tangible, credible, actionable path to their next big home run? How do you make your success story their success story?